Hello. This video, I genuinely believe, will probably be quite different from all the other moving average videos that you may have come across until this very moment. On YouTube, it's all about the 5, 10, 21 period moving averages. The 50 period and 200 period moving averages are talked about quite frequently. But despite its importance, it's strange that nobody ever talks about the 3 moving average.
It's the 3 moving average. Most traders find the 3 MA to be too short.
They believe it's overly sensitive, generates too much noise, and ultimately proves to be impractical for real-world trading scenarios. Thus, its significance is often overlooked. However, I, on the contrary, hold an entirely different perspective. The exact reason why people tend to disregard the 3 moving average is precisely what makes it such a crucial indicator. That's because the majority of you tend to believe that something more complex is inherently more significant and powerful. You believe that a greater number of indicators leads to more sophisticated analysis and that an increased number of lines on the chart will. I think that's precisely what makes it accurate. However, the market does not operate in such a predictable or linear fashion. The market's movements are ultimately dictated by price, and price consistently seeks out and strives for a state of equilibrium. And one of the lines that most quickly and clearly shows this equilibrium is the 3 moving average. The 3 candle. And here's the core insight. The candlestick will invariably converge with the 3 moving average. The candlestick always makes contact with the 3 moving average. If you observe closely, the 3 moving average is positioned above. The candlestick either ascends above it, encounters the 3 moving average there, and subsequently descends, or the candlestick actively pulls the 3 moving average downward. That's why it always meets the 3 moving average.
Many traders, when observing the market, typically only react after a significant movement has already occurred.
They say it's strong if it rises sharply, weak if it falls sharply. However, what is truly crucial is not the interpretation of the movement after it has already occurred. See how it's going up? When I see that, I use the 3 moving average. I'm not going to begin with a complicated explanation. Let's delve directly into the fundamental essence of the matter. A new candle starts to form. A single candlestick begins its formation. This newly formed candlestick, once it has started, will. This candlestick, once it starts, will often drop from its opening price and then go down to the 3 MA. It will either drop from its opening price to meet the 3 MA or rise from its opening price to meet it. This happens very often. Now, if you look at the indicator, we need to adjust the input's length to 3 and the moving average. I will try to make the shape much bolder now. Of course, there are exceptions. The market always has exceptions, but the 3 MA. It meets, then moves, and only then does it proceed with its subsequent movement. In a strong trend, it might momentarily diverge, and a large candle can briefly disrupt this connection. Yet, its nature is quite straightforward. You can observe it on MyNet and daily charts. It's also apparent on monthly and weekly charts. The critical aspect is that as the time frame lengthens, the reliability of this principle also significantly increases. This is crucial because most traders end up getting caught up in short-term fluctuations. They get excited by 1-minute chart gains, anxious when the 5-minute chart dips, and a brief tremor alters their strategy. It begins to reveal where the market is attempting to establish its point of equilibrium. I don't simply view the moving average as just a brief short-term indicator. It is a line that indicates where the price currently stands and where it's highly probable to move towards. It is the 3 moving average line. The 3 moving average. To be precise, you can't know everything from the 3MA alone. However, it allows you to grasp a crucial starting point that many people often overlook, which is incredibly significant. And what exactly is that starting point? It's the intrinsic relationship between the price and the moving average itself. So many people only look at the candlestick's shape, just the shape of the candle. Is it a bearish or bullish candle? Does it have a long lower or upper wick? What is the relationship between this candlestick and the line? How strong is that relationship? But once you grasp the relationship, the chart looks completely different. The moving average is still positioned above the current price level. Ah, the 3MA remains below. That's how you really begin to interpret the chart. Its simplicity often leads to it being overlooked. Yet, in practice, this very simplicity makes the 3 moving average such a powerful and resilient indicator. Alright, so after observing today's daily moving average, let's now take a moment to look at the weekly chart. We'll examine the broader trend. On the weekly chart, the moving average line consistently intersects with this candlestick. It's always touching the candlestick, the opening price. If the opening price forms and the 3 moving average is above it, the price will first go up before coming back down. And it's the same for the monthly moving average and the daily moving average. It's the same for the daily and the monthly. Now this one here is the monthly moving average. You see, the opening price began at this point, but because the moving average is positioned above it, the price rises, creating an upper wick, and then it meets the moving average. It always makes contact with it. Alright now everyone. Let's check the 12-month moving average. The 12-month moving average. Alright. Here is the moving average. The opening price began its journey from this point here. The 3 moving average, positioned right here at the bottom, indicates that the candlestick initially drops, ultimately meeting the 3 moving average. This specific interaction, a large time frame, like a daily or weekly chart, looking at monthly or even yearly charts, you'll begin to discern the general direction quite clearly. Once you become proficient with this technique, you will be able to anticipate the market's movements, specifically predicting the direction and behavior of candlesticks with greater accuracy. To delve a bit deeper into the intricate connection between larger time frames and smaller minute charts, the time on the large time frame, its opening price starts here. For instance, let's consider a scenario where the price opens at 100 and the 3 moving average is positioned at 50. So it's a larger time frame. It's a large time frame. So then, on the smaller time frames, like the minute chart, it will begin to show a decline. So, when it encounters the 3 moving average right at this point, you would typically proceed to liquidate your sell orders. Does that make sense? This trace of equilibrium that the price is heading towards for all of you. Now, it seems quite likely that for this year, 2026, there's a higher probability of an even greater decline in prices. This movement directly begins from the opening price of the candlestick. Right from the initial opening price, you first observe its interaction with the 3 moving average. This allows you to accurately predict whether this candlestick will move downwards first or it will ascend first. This precise foresight is precisely what the 3 moving average provides. Alright, if you look here, you can see the 3 moving average is currently above. Now, for the subsequent candlestick, if its opening price is positioned above the 3 moving average, while the 3MA itself lies beneath, then even if the candlestick ultimately ascends, there's a heightened probability that it will first descend, thereby forming a lower wick, leaving a shadow below before its eventual rise. Sometimes, a candlestick will exhibit an incredibly strong trend, pulling the 3 moving average upward significantly until they eventually converge. Now, when the next candlestick moved upwards like this, it became a significant long bullish candle. So for all of you watching, what about the next candle? The opening price. The opening price starts up here, and the 3 moving average, at best, will only follow up to around here. Therefore, if, after an initial fall, the price is to continue its upward trajectory, you will very frequently observe it forming a lower wick before it then proceeds to climb upwards. Now, what's crucial here is that the larger time frame serves as a leading indicator, essentially guiding the 3MA of the smaller time frame. You look at the weekly chart to read the daily to read the 60-minute, and then, after understanding the 60-minute, you proceed to read the 5-minute and 1-minute charts. See, it's moving just as I said. The opening price started here, but the 3 moving average is below it. Therefore, it's anticipated that it will first drop down to meet the 3 moving average, then form an upper wick, and subsequently move upwards, showing a clear ascendant trend. Like this, on large time frames, weekly, daily, on the monthly, even yearly charts, if you first observe the 3 moving averages movement and its position, you'll be able to tell whether it will go down and then up, or conversely, go up and then down. That's the power of the 3MA for you. This 3 moving average is precisely what enables you to predict, at least to some extent, the direction of the stock price and the movement of the candlestick. When you are able to anticipate movements like these, while navigating blindly through uncharted territory in this Nasdaq futures market, knowing absolutely nothing about what lies ahead, you're small. I truly believe it will serve as a guiding light, like a small candle flame, illuminating your path ahead. Alright, that brings us to the end of today's video. So, everyone, if you found this video helpful, please don't forget to always hit that subscribe button and give us a thumbs up. Thank you.